Thanks for tuning in to Talking Point. I'm your host, Niraj Shah. And today is turning out to be a really interesting day to have the conversation that we are going to have, simply because the world markets are kind of poised in how do I say, viewers, a very interesting position, both fundamentally and technically. Fundamentally, I can tell you, with the Fed meeting slated to come out later today, and the Fed decision slated to come out, maybe a stimulus move coming out, vaccine is in full steam, but the US, the epicenter of all flows largely, is seeing record coronavirus cases. And if indeed we get shutdowns, as we already started seeing in Europe, in the rest of the world, and maybe in US as well, then it puts us in a bit of a bind as to how this shapes up. The question is, therefore, that if fundamentals are not able to provide a clear direction, are technicals able to do that? Let's ask our guest, how does he read into the charts? As he joins in, needs no introduction, really. Gautam Shah of Goldilocks Premium Research joins in right now to talk about that. Gautam, good having you. Thanks for joining in. I hope all is safe.
Thanks, Niraj. Yes, all good. Thank you.
That's good. So, Gautam, tell us, if you can start off with the global picture, Gautam. How do the charts look there? Because India fundamentally is looking slightly different on the COVID front. So, I first want to get the global picture out of the way.
Well, Neeraj, it all started in a global way in the month of March, because when the US market started to bottom out and started to witness a V-shaped recovery, India just followed in tandem. In fact, for the last 4 or 5 months, if you look at the European indices or some of the other Asian indices, whether it's a Hang Seng or a Singapore or a China, many global indices actually underperformed in the last 6 months because they were not able to move in tandem with the US markets. India was probably one of the only markets in the world that moved hand in hand, with the US market indices. So I think what the S&P 500 does is extremely important to what the Nifty does here. I mean, how much ever we might not want to agree, but that's a correlation which has really existed this year completely and over the last many, many years. And as I study the charts, even at this point of time, I think you rightly pointed out the fundamental concerns, but I do believe that the market is looking at things 3 months, 6 months in advance. And that's probably the reason you are at 30,000 and beyond for the Dow and 13,500 on the Nifty. And as I look at the charts of the US markets, I think there is still some more juice left. I don't think you're going to see any massive correction, at least in the near term. And our working target for the Dow is about 30,900. So there is still a good 3, 4, 5% upside out there before we see any correction. And if you look at the European markets, the Asian market indices, all of them are looking well placed. So at least for the near term, when I say near term, a couple of weeks or 3 weeks, I think the trend should be okay and the markets can carry on this momentum.
Gautam, is it possible to look beyond 3 weeks as well and talk about that if indeed, I mean, I heard you mention that we probably are good for under 2, 3, 5% on the Dow. Post that, if there is a possibility of a correction, and maybe you can't predict it right now, but if there is a possibility of a correction, could that correction be steep in nature? Or do you reckon we are in a space wherein all cuts get bought into?
Markets are overextended, no doubt about that. You look at any technical parameter, it's just the momentum and the lack of any negative news flow, that's just propelling this market higher. Obviously, you can call it liquidity. You can call it the fact that there is this news about vaccine, thankfully, which is helping markets move higher. And this is the month of December. In our note in the first week of December, we made the point that seasonally, if you look at the last 20, 25 years, this is the month where 75% of the time the Nifty does well. You haven't seen massive corrections, not once in the last 20 years in this month of December. I mean, there is logic to it in terms of liquidity, FIs going on a holiday, the feel-good environment, and the fact that you really don't get too much negative news. So I think a correction is coming, but it's coming in the month of January. I think that's really the inflection point. So for the next 2.5 weeks, I think we should be safe. There could be some more near-term strength for the headline indices, but nothing substantial. In terms of risk reward, these are not levels where you want to increase leverage longs. I think there are still a lot of opportunities in terms of sectors, and stocks will continue to do well, but the headline indices do not have too much room. So near term, we are expecting a sort of a pause or a correction, to pan out in the month of January. It could be to the extent of 5 to 10% as well. I know the screen today might not indicate that, but the charts are already indicating. But as I said, it's just the momentum which is taking it higher. But if you have to really look at it longer term, if I have to take a view for 2021, I think our bigger picture working target is now 15,500 for the Nifty. So for almost couple of years, we were working with 13,000. That got done, and with what markets have done now, that's our bigger picture, longer term target. Which we play for, and we buy the dips on every correction.
Okay, so let's talk about the Nifty then. Currently, it doesn't seem like that there is an immediate correction at hand. We may correct a bit in January, and then the longer term picture looks interesting. How do you think it shapes up? Do the charts indicate that this stopping will happen in line with what the US markets do, or could it decouple? That is part one of my question. Part two of my question is, would you expect this to be a large, broad-based index rally, or is it possible? If it's possible to even say that, or could it be a narrow, concentrated rally within the Nifty?
Well, I don't think India can get decoupled with the US, that's for sure. This correction should have actually happened early December itself, because on the technical parameters, we are already extremely overstretched. We are at the kind of historical levels on so many studies that it's just baffling, because history does not give you any reason to study the markets right now. Just to give you a simple statistic, on the Nifty 500 index, 95% of the stocks are trading above the 50-day moving average, and this has happened on a sustained basis. Typically such readings stay for a day or two, but now for almost 6, 7, 8 days you have such an extreme reading, which I haven't seen in my 20 years of tracking markets. So these are extreme scenarios, but as I said, because the momentum is great, you don't want to fight it. And I think the best way to play current markets is to work with a trailing stop loss. And I think the period that comes closest to what has happened in the last 6 months is the period of 2003. If you remember, 1,000 Nifty became 2,000 in a matter of about 9 months, and even at that point of time, things remained extended for a long period of time. But as I mentioned, the risk reward based opportunities are currently in many of the niche sectors. There is clear, lovely bull market, sector rotation which has been happening for the last 6 months, and there are many opportunities like FMCG, PSU, auto, IT, and pharma, where we remain very bullish. And I think irrespective of what the Nifty does, some of these sectors give you lovely opportunities.
Okay, so let's try and talk about some of these themes, Gautam. Can I start off with one, though, which is top of my mind, even if we don't have a chart there? Metals. It just had a breathtaking move, and every large, notable, fundamental house worth its salt, Gautam, believes fundamentally that we are in store for much more earnings upsides in 2021. Companies themselves are very confident, both about utilization levels moving up, prices staying stable, and earnings showing growth. What are the charts telling you now? Are they telling you something different?
Niraj, a couple of months back, or a few months back, when we interacted on this very show, I spoke about metals being a dark horse, and I think we've been putting it out in our notes on a regular basis, because I think many months back you had that first indication on the charts that something unique is happening. Metals was in a massive bear market for almost 3 years. It came out of a bear market, it completed a large cycle on the downside, and look at the kind of returns that some of these large cap metal stocks have given you. It's almost the mid cap and the small cap variety. This is going to continue, no doubt about it. I think this is a multi-year bull market in the metal space. But at these levels, do I recommend buy? Not at all. I think they are overly extended. What's happening on the ground is now being talked about, as you highlighted in most of the brokerage notes, which is understandable. But the market saw it 6 months back, and that's probably the reason you've had this 60% rally, I think, in a matter of 7 months. So at these levels, I think our targets have been met. I don't see great risk reward at this point. But I think some of the other spaces, what metals has done so far, I think FMCG and auto might do over the next 6 months. So those two might be my better picks.
Okay, so that's a telling statement. What metals have done thus far, auto and FMCG could do over the next 6 months. Gautam, just wondering, so for the Tata Steels, Vedantas, Hindalcos of the world, you would not recommend buying fresh, or would you recommend booking profits, or would you recommend keeping trailing stops?
Well, if you're somebody with a trading mentality, and given the fact that I do expect a correction in Nifty, to come in the month of January, I think some of these overextended stocks will see a correction. So this might actually be a good time to book profits while everything is great on the screen, and in terms of fundamentals and on the charts. But if you're a long-term investor who can digest volatility, who can digest corrections from time to time, just hold for greater returns.
Okay, so keep that at the back of your mind. Okay, thanks to my producer. These are the kind of gains that Gautam was referring to. Some of the large caps have moved like mid caps. I mean, this is a 6-month function on the Bloomberg 9% like mid caps. Splendid moves for some of these. Okay, let's move on. Before I get to the FMCG and the auto pack discussion, Gautam Shah has given a very interesting chart on IT, wherein I think he's saying that IT is forming a bit of a base here. And if I read your note, Gautam, you are suggesting that even if the index is correct, IT could move in a different fashion. Can you talk a bit about this?
IT is in a mega bull market. I think I've been speaking about this for the last 6 months. I think this bull market is still halfway. The kind of strength with IT stocks are likely to see over the next 6 or 7 or 12 months is going to be mind-boggling for a lot of people. And you get that indication not in absolute terms, because in absolute terms the IT index is already at lifetime highs. If you look at the indicators, you might feel that it is extended. You might feel extremely concerned about buying at these levels. But if you look at the ratio chart, which is IT index divided by the Nifty, you see that a breakout has taken place only a couple of months back from a range which had existed for almost 4 years. So I think this is a start of a multi-month, multi-quarter uptrend for IT stocks, and I think they will continue to do well. And this actually provides a lot of cushion to the Nifty, because IT is a huge component. So in terms of levels, we are looking at 24,000 in the near term, and I think our medium-term target for the IT index is about 26,500. But more than the upside, what gives me a lot of comfort is that IT gives me a lot of margin of safety. Even if the Nifty were to go through a correction, say in the month of January or any time, I think IT stocks will actually do well. And we've seen this in the last 5 or 6 days. The day there is an intraday dip of 100 points on the Nifty, suddenly the money starts flowing into IT or defensives, IT and pharma. So the structure is great. I think it's going to carry on. When I look at the weekly and the monthly charts, I don't see any indications of topping out. And all the top line stocks, HCL Tech, Wipro, Infosys, I think could give you anywhere between 30 to 50% upside in 2021.
30 to 50% upside in 2021. Incidentally, Credit Suisse note this morning speaks about a 15% immediate upside possibilities for the likes of HCL Tech and some of the others too. So I'm just trying to marry the fundamentals and the technicals out here, viewers, so that you get a perspective. Now, some other charts that Gautam has given us, but before that, the comment that I said intrigued me, Gautam. FMCG and autos, you reckon could actually do what metals have done. Can you speak a bit about this?
Yes, I think auto was probably one of the earlier sectors to bottom out and start to rally, and you almost saw a V-shaped recovery. If you look at the kind of gains many of these stocks have registered in the last 6 months. So while we were assessing the sector, we were unsure whether this is overextended and whether are they ripe for a correction, or was this just a foundation rally to a much bigger rally ahead. When I look at the auto index, I get indications that you have the RSI, which is hitting a lifetime high. So when the price action is at a multi-month high and the RSI is hitting a lifetime high, these are trends which continue for a long period of time. So I think this correction of the last 5 or 6 days and the fact that the auto index is currently at levels around 9,000, I think is an opportunity to buy. A lot of stocks are setting up for much bigger moves. We have been liking Maruti. I mean, if you look at the chart of Maruti, Eicher Motors, Tata Motors has been our dark horse, which we've recommended a few times. Ashok Leyland, M&M, I think all are great charts. And our working target for the auto index is about 10,500. So again, I think this index will stand out even if the markets go through a bit of a correction. And the charts are almost telling you that on the ground, things are picking up. And with the COVID situation, obviously, the industry is going through a change. I mean, the thought process around buying autos, I think, is itself going through a change, and that's, I think, visible on the charts. And I think something similar is happening with FMCG, because the index was an underperformer for 6 or 7 months. HUL did nothing for such a long time. ITC was laughed about when it was trading at 165, 170. Look at the rebound of the last 1 month. It's almost like a relay among sectors, helping the Nifty higher. The FMCG index took out that level of 32,500, which I thought was a breakout from a 1.5 year range. And our working target for that index is about 36,000. So I think ITC will continue to run. Britannia looks great. Nestle, I think, will continue to run, maybe a level of 20,000 over the next few weeks to few months. Dabur is setting up for a rally. Marico and Colgate have lovely medium-term setups. And just like IT, I think FMCG gives me a margin of safety. So even if the Nifty goes through a correction at some point of time, I think IT and FMCG should remain safe. And your portfolios at such elevated levels need to be, topped up into them.
Yeah, guys, from a portfolio construction, I think Gautam Shah makes such an important point as well. Just don't look at it from an individual bottom-up perspective. The whole portfolio construct piece that he's talking about is very, very important. Gautam, just a follow-up on autos, though. The answer gave me a feeling that you believe four-wheelers stocks are looking strong. What about the two-wheeler majors or three two-wheeler majors? Or what about tractors? And what about auto ancillaries? I mean, do any of those look as buoyant, or are you biased towards the four-wheelers on the charts?
Well, I would be slightly biased towards the four-wheelers, for sure. I think that's the kind of chart setup that I see, and clearly Maruti has been our top pick all along, and I think it will do exceedingly well over the next. In fact, this is a stock that could really be one of the star performers of 2021, the way I see it on the chart. So remain very positive there. Auto ancillary, I think, could be the dark horse sector for 2021. When you have the mother sector doing well, the auto sector doing well, and when I look at some of the auto ancillary stocks and the kind of valuations they are trading at, sorry, I'm a technical guy, but I'm speaking valuations because we try to merge all of it. So the kind of institutional interest which is coming into auto ancillary, the kind of valuations and the kind of charts, and the fact that auto ancillary went through severe wealth destruction for many, many years. So this comeback looks good for many of the top names, but play auto ancillary not from a trading perspective, but for the next 6 to 12 months, or maybe even 3 years if somebody wants to play that time frame. So yes, autos will give you supernormal returns, but auto ancillary might just give you a fortune making opportunity.
Okay, that's a telling thing too. By the way, a bunch of auto ancillaries are actually doing much better. Gautam, just a quick follow-up to that. Would you be comfortable adding on to, I know you said that you'd be comfortable adding on to IT and FMCG, even if the Nifty were to correct, they're kind of defensive in nature. Autos aren't exactly in the same bucket, right? So would you be comfortable adding on to autos right now while you're expecting a correction in Nifty in January?
That's a good point, and that's the exact question which we've been trying to address within the team. Because on one hand we are a little uncomfortable with the Nifty, and autos are high beta. They go up with the Nifty, they come off with the Nifty. So I'm being very choosy here. So I wouldn't really go overboard with all the names because many are overextended, but there are a couple, which I think have seen very clean breakouts, and Maruti is right up there, which I've said a few times.
Okay. Last couple of questions, one on a sector, one on the whole portfolio construct, Gautam. One on a sector. When I look at the 6 months, aside of IT and telecom and pharma, the one pocket that did really well, of course not mainstream, but did really well, were specialty chemicals. A bunch of these companies had some very good moves and very stable moves. They've gone a bit quiet off late, Gautam. The SRFs, Vinati Organics, Deepak Nitrites of the world. Have you looked at the charts of any of those, and do you see strength or do you see weakness there?
Well, longer term perspective, I still see a lot of strength. I don't think there has been a single stock that we've not covered at Goldilocks in the last 6 months because the charts just have been absolutely perfect. Believe me, it's no rocket science. When stocks make higher tops and higher bottoms on great volumes, you buy them. And I think every single stock in the specialty chemical space has done that. And obviously, I hear a lot of good things on the ground fundamentally as well. A lot of people talk about it as a structural trend. I think this is definitely a structural trend, the way the charts are placed. but risk reward, I think at 13,500 you don't have risk reward to buy fresh at these levels. So if you're sitting on serious gains, you might just want to book some profits, come back slightly lower, because I'm pretty sure that when the Nifty goes through that correction, I think many of these high flyers will go through that patch of correction because people are sitting on large gains. So risk reward, I think, is the most important aspect, and which I really don't see in the specialty chemicals. But one other sector which I think there is a bigger opportunity playing out is PSU. I have disliked this sector for almost 10 years. I thought I must highlight it. I think you have a genuine breakout taking place on the charts in the last month. I would not go by the PSU banks, but everything else in PSU I like. So I'm not chasing the PSU banks at all, and I'm not recommending a buy there. I think that's more of a momentum trade, because some of them are in FNO, but I think many of the other stocks in the PSU basket, some of the power names, a BEL of the world, RITES, rights, lovely charts, and I think they could be potential wealth creators for a change, for 2021. And the dividend yield angle is there. Supports are not very far away. So PSU and realty, I think, are two spaces which could also surprise.
Can I squeeze in a question about OMCs, Gautam? PSUs, there is fundamental action there. How do they look?
OMCs are looking great. They have seen false starts so many times in the last couple of years that people have just given up on them. Every time you feel that, okay, now the breakout is coming, it just falters and goes the other way. And obviously, there is so much which has happened with the BPCL divestment, which the charts have not been able to handle because they have been very volatile. But at these levels, just a couple of days back, we covered one of the OMCs, and we are, liking another. And I think this could finally be the real breakout. And if this is the real breakout, the top two OMCs can give you 25% upside from here. And clearly it is a large component of the PSE index. So, it's all merging very well together.
Got it. Gautam, my final question on this interaction. And that is, as you said, there are so many charts which look so good. When you are, say, on your personal portfolio or some of your top clients' portfolio, are doing these trades, investing, etc., how many stocks do you typically are comfortable with? A lot of people know fundamentally that there are theories about either keeping 8 stocks or 10 stocks, or at times people say, okay, keep 25 stocks because that's about it. What about an optimum trading portfolio or an optimum investment portfolio from a chart perspective? How many stocks are you comfortable with?
Well, 2 points here. I think firstly, you need to understand the pitch. When the pitch is conducive for test cricket, you don't want to be playing 20-20 every day, trying to take out 3, 4, 5%, which might seem very exciting. But look at a Bajaj Finance. It's at a lifetime high. I mean, look at the kind of levels many of these stocks were trading at in the month of March. So I know a lot of people are very happy making money every day, bit by bit. But this 2020 was a wealth creation, opportunity. And I think this is likely to remain this way. So the pitch is important. So far, the pitch has been for test cricket, and that's probably the reason we have been recommending more of buy and hold. But from a portfolio standpoint, we don't recommend more than 15 stocks at any point of time. So we like to identify 4 spaces, 4 sectors, which we think will outperform the Nifty. And, we like to make our commitments in those 4 sectors. And believe me, in today's market, it's very difficult to outperform the Nifty because sometimes IT takes it up, sometimes pharma takes it up, sometimes Reliance just takes it up, sometimes it's the banks. And as a portfolio, you cannot be moving into multiple sectors, every month trying to outperform the Nifty. So it's an extremely difficult task. But identify 4 sectors based on relative strength and make your serious commitments into them, which right now is IT, pharma, FMCG, and auto.
Okay, we've driven home that point. And viewers, I hope this interaction was as interesting for you as it was for me. Gautam, pleasure talking to you. Thank you so much for joining us today, and wishing you and yours a very safe time ahead.
Thanks, Niraj. Thanks for having me.
And the pleasure was ours. And viewers, thanks for tuning in to this edition of The Talking Point.